Hey traders, Mike Sir here. Bonds are not a preferred trading asset for retail traders, mainly due to its perception of being too complicated. But in this video, you can learn a lot from one of the most successful bond traders in the world who made his billion-dollar fortune by trading bonds. His name is Bill Gross. Nicknamed the Bond King, Bill managed one of the world's largest mutual funds, focusing mostly on bonds and fixed income investments. Before Bill began his investment career, he spent his time gambling and counting cards at poker tables in Las Vegas. Now, this experience would prove valuable as he would earn his financial credentials while working as an investment analyst for Pacific Mutual Life. Later on, Bill will co-found Pacific Investment Management, or short for PIMCO, to create the first investable market for fixed income securities accessible to all investors ranging from institutional investors, high net worth individuals, mutual funds, and individual investors. Now, prior to PIMCO, bonds were rarely traded. They were mainly bought and held for the long term by insurers and pension funds, and transactions were done only through paper documents. With Bill's aggressive bond investing, he turned the once quiet bond market into a destabilized game of high risk and high reward. Now, Bill was known for his ability to identify and exploit inefficiency in the markets and would actively trade in and out of positions. As well, he was able to adjust his trading strategies based on market conditions, embrace new technologies that would give him an edge in the fixed income market, and later expand into high-risk areas like junk bonds and emerging markets. And Bill would have a lot of trading success. Over a 30-year track record in the bond fund, if you had invested $100,000 with Bill at the end of 1987, you would have netted over $500,000, a 500% return. Now, if you look at the chart, his fund was incredibly stable despite numerous stock market crashes over a 30-year period. And this is why Bill controlled more bond money than anyone in the world, managing PIMCO's total return fund with more than $293 billion in assets. Before I share with you Bill's trading strategies, I want to let you know that this video is sponsored by Axie Select. Now, Axie Select is a unique program designed to guide your trading and support your success. It's an all-inclusive capital allocation program which provides a structured pathway for traders to access funding of up to $1 million USD and keep up to 90% of the profits while paying zero registration or monthly fees. Axie Select is free to join as there are no registration fees or ongoing membership fees. Trading with Axie Select gives you the opportunity to enjoy unrestricted trading conditions while being protected by a multi-licensed and trusted broker. All you have to do is first register and then deposit at least $500 USD into your account, start trading, and once you achieve an edge score of at least 50, you get funded in a separate allocation account anywhere from $5,000 to $1 million USD. If you're new to the world of trading, they have an entire trading academy online where you can deepen your knowledge and know everything about trading in a simple and engaging way. They even have demo accounts so that you can try on different strategies to find the best one. Just click on the link in the description box below, go to axie.com, register, join Axie Select, and start trading today. Overall, Bill was described as a good trader, a good analyst, and a good salesman, and able to distill complex ideas into something simple and accessible. His trading strategy to be able to beat the market for much of his career was by exploiting the element of certainty and mastering the element of uncertainty. Now, certainty for a bond investor like Bill included variables such as credit ratings, yields, maturities, and duration, a measure of risk. The longer a bond's duration, the more wildly its price fluctuates when rates change, with cautious investors choosing shorter-term durations to limit price volatility. Now, for example, if interest rates rise, then Bill might reduce the bond fund's duration by selling long-term bonds and buying shorter-term bonds. Duration is a measure of a bond's sensitivity to interest rate changes. Shorter duration bonds are less sensitive to interest rate fluctuations, so their prices are less likely to drop significantly when rates rise. Now, Bill took advantage of uncertainty by making educated but accurate guesses on the direction of interest rates, as well as inflation and other variables that affect bonds. For example, if Bill believes that interest rates are about to rise due to an improving economy and a more hawkish stance from the central bank, then he would adjust his bond portfolio by selling off existing bonds with lower yields because these bonds would decrease in value. As well, he might change the asset allocation of the fund to include more floating rate bonds or securities with variable interest rates because these investments tend to perform better when interest rates increase. Lastly, he will adjust his sector exposure by reducing exposure to long-dated government bonds, which are particularly sensitive to interest rates, as well as increase exposure to sectors that are less interest rate sensitive, like corporate bonds with higher yields. In addition, active aggressive bond investing was Bill's big innovation. Historically, insurers and pension funds were the big buyers of bonds. They rarely traded. In fact, bonds were typically kept in a vault, and selling meant physically mailing them to the buyer, and enjoyed cordial, clubby relationships with Wall Street. PIMCO, on the other hand, actively traded in and out positions, expanded into hot new areas like junk bonds and emerging markets, and used its increasing clout to coddle banks into giving them better bids. Now let me share with you several of Bill's best trades ever. One of Bill Gross's most famous trades was a trade where he's avoided substantial losses during the financial crisis of 2008. It was his early recognition in 2007 of the risk in the subprime mortgage market, which led him to significantly reduce the PIMCO total return fund's exposure to subprime mortgage-backed securities, anticipating the market's collapse of these securities. Now, this move helped protect the fund's investors from massive losses, and shortly after, he had one of his most successful trades ever by buying large positions in agency-backed mortgage bonds of home loan giants Fannie Mae and Freddie Mac. Now, his belief was that these two entities were just too big and too important for the government to let them fail, as it would cause huge ramifications to the US economy. Well, his intuition was right, as his fund netted a $1.7 billion profit after the US government took over these two companies in September 2008. Now, bond investors benefited immensely, while shareholders were left with pennies on the dollar. Also, Bill was known for his ability to make big contrarian bets, where he was often right more than wrong. In 1994, Bill bought one-year Mexican bonds that were paying a yield of 19.75% during the Mexican currency crisis, and the government was teetering on the brink of default. Now, his bet paid off again as the US Treasury Department and International Monetary Fund agreed to lend tens of billions to help stabilize the peso currency. However, over the next 5 to 10 years, due to lackluster returns and declining assets, Bill left PIMCO in the fall of 2014 and joined Janus Henderson Investors. Now, after another 5 more years at Janus, he retired from the fund management industry to focus more on managing his personal assets and private charitable foundation. Thanks for watching. If you like this video, please hit the like button and hit subscribe. I would really appreciate your support. I'll see you all in the next video.